making it challenging for the fund managers to choose the next best stock. When you keep getting more and more flows, you need the next horse.
Why isn't everyone doing it? Why is it still that big gap, or why is it still that hesitation? And what do you think is going to lead to filling up that gap?
Who has been one of the greatest active investors ever, I believe. He has also recommended
Total Market Index as your maiden offering.
wanted our maiden fund offering, which we hope will also become our flagship fund.
So you've really broken down a lot of myths. It is not for first-time investors.
So we believe passive investing and passive strategies is not only for learning license type, but for all from if you want excitement, take $800 and go to Las Vegas,
Yes.
right? So investing via ETFs and index funds may be dull and boring, but let me tell you, it will help investors.
Hello, everyone, and welcome to The Passive Edge, a podcast where we cut through the noise and help you to build wealth the smart way. I'm Avan Dabash, and in today's episode, we'll be talking about something that's really exploding across the investing world: passive funds. Now, if you're wondering what exactly is a passive fund, or should I be investing in one, you're not alone. With young investors also entering the markets and really looking for simple, low-cost, transparent investing strategies, passive strategies are having a major moment. In fact, India's mutual fund industry recently crossed 72.2 lakh crores as on May 2025 in assets under management, and passive funds are making serious waves. In fact, they are already accounting for 17% of the overall AUM. So what exactly is fueling this shift? Joining in today, we have Hemen Bhatia. He's the ED and CEO of Angel One Asset Management Company, and he's really been at the trenches of India's investment space for over 2 decades. His AMC has launched a bold, passive-first approach, and today we'll find out why. Hemen, welcome to the show. Thank you so much for joining in. I think there's so much to really unpack and talk about when it comes to passive investing. So thank you for being with us today.
Thanks, Avan, for having me on this podcast. Thank you.
So I think let's just get down to the basics, okay? What exactly is passive investing, and how is it different from what we hear so much, which is active investing?
Sure. See, Avan, I'm sure we all are familiar with active investing,
Yeah.
whether we've heard of the term or not. The objective of active investing is to beat or outperform the relevant market index. And this is based on the premise that market misprices many stocks and securities, right? Hence, active investing is about stock picking done by investors or say fund managers, the professional fund managers who do stock picking. And some tools of active investing used by fund managers are fundamental analysis, technical analysis, macroeconomic analysis, and so on. So there are various tools which fund managers do to choose the right kind of stocks. So it is important to note that active investing relies on huge quantum of data and information available in the present, based on which fund managers attempt to forecast and predict about individual stocks, sectors, or say interest rates, or say even the oil prices, right? So it is almost like attempting to seeing in the future based on the present data. Now, on the other hand, if we talk about passive investing makes no attempt to beat the market, as it is investing in the market itself.
Right.
So while you choose a particular benchmark, you are investing in the constituents of a particular benchmark. Hence, passive investing eliminates the need to hire expensive analysts or fund managers, or say a lot of chartists, economists. All this ultimately adds to the cost of the cost to the investors. Cost of investing increases, which is eventually a drag on the returns which the investors get. So passive investing believes that market prices are fair, as it reflects the collective opinion and wisdom possessed by thousands and lakhs of participants that include numerous fund managers, portfolio managers. You will have multiple pension funds, you will have multiple FPIs who are pricing the securities in the market. So multiple analysts are pricing it. So we call it collective wisdom. Hence, the resolve of passive investing is that it is almost impossible for any individual to outguess the collective market wisdom consistently. See, understand why I'm using the word consistently. You can outguess once, twice, but to do it consistently is very challenging. Therefore, we can say that active investing is relying on individual wisdom of the fund manager versus collective wisdom of the markets in case of passive investing.
Okay, collective wisdom of the markets, and you're saying that it has been consistent, but let's talk about data. Has it really picked up in India as much as it has globally? And can you just give us some context? Because you're talking about this consistency. Can you give us more context to that?
Sure, Aman. See, equity markets across the world, they go through various phases
Of course.
with growing economy. And globally, as equity markets have matured over years, it has become very challenging for active fund managers to keep beating the markets and generate alpha on consistent basis. In fact, if you look at the global US PWA data, almost 75 to 80% of the active funds have been underperforming their benchmarks over long periods. I'm not even talking about short periods, over long period of say 5 and 10 years. And as per our internal analysis, we are seeing a similar trend in India too. So earlier we could see difficulties for Indian fund managers to consistently generate alpha in the large cap space. But now that challenge has spread even to the mid caps, small caps, and even the flexi cap segment of the Indian capital market, where almost majority of the fund managers are underperforming or unable to consistently beat the appropriate indices if compared on apples to apples basis. Very important. I repeat, if compared on apples to apples basis.
Okay.
And the reason for this is with more and more financial inclusion, we are getting continuous flow of money into mutual funds, making it challenging for the fund managers to choose the next best stock. See, when you keep getting more and more flows, and if you have to keep beating the market, you need the next horse.
Yeah.
घोड़ा चाहिए ना, next
Yeah.
घोड़ा चाहिए basically.
That's gonna
कौन सा
win.
घोड़ा चलेगा अगले 3
Yeah.
साल 5 साल 7 साल? You need that, and you need to keep doing that consistently to beat the market.
Absolutely.
So that way it becomes very challenging. And practically, if you ask me, there's no information edge that individual analysts or fund managers can possess consistently relative to their peers who are also into the same business, doing the same thing. Everybody is trying to beat the market. So it is like you are not only, you are challenged by all the market participants who are into the business of generating alpha, and you have to outguess all of them. So I would like to provide a quote from a famous financial journalist here.
Okay.
He says that alpha has always been perishable, but in today's world of instantaneous information, alpha is likely to have the shelf life of an unrefrigerated fish.
No, that's really well put it. Yeah. But so let's talk about India in specific. Is it now picking up? What is the data? What are the numbers suggesting? If you want to give us context as to how it fares versus the rest of the globe?
If you see in India versus globally, so globally, if you see the passive funds AUM, it has grown from 10% of the overall AUM, and specifically I am talking about the US markets.
Yes.
It has grown from 10% of the overall AUM to almost 40% at the end of 2024. And we are seeing similar trend in India too. In India, at the end of 2010, if I remember the numbers right, the AUM of passive funds was just 50 basis points. That is 0.5% of the overall Indian mutual fund industry AUM.
Okay.
From 0.5 in 2010, it has grown to 17% currently. So the trend which was visible globally, especially in the US markets, which is one of the largest capital markets, we are seeing that similar trend in India as well. Yeah.
So there's a lot of tailwind. You're saying there's
Yeah.
still a lot of room for growth when it comes to
Of course,
passive
of course.
investing.
Because what happens is, see, the challenges of consistently beating the market, they are same across the world.
Yeah.
It is not that something which is true to US is not true to India. What happens is, as I said, with different markets have different growth phases, and at different point of times, ultimately everybody who is doing the stock picking, they are going to face challenges with more and more money flowing in. The stages will be different at different point of time, but the challenges are going to remain the same.
Okay, so Hemen, there still are a lot of myths surrounding passive investing. One being that passive investing is for first-time investors. What do you have to say about that?
See, Aman, this is a hilarious gimmick that makes it seem as if passive investing is akin to learning license plate that we used to see on the cars with freshly minted drivers, Nothing can be further from the truth.
Okay.
Investments are actually about lowering cost and risk. So equity investment actually has two types of risk. One is systemic risk and one is non-systemic risk. What is systemic risk? Let us break down. See, systemic risk is common to all kinds of investing, be it passive investing, be it active investing, because it is common to all. For example, tomorrow if there's a pandemic or if there's a war, all kinds of portfolios, be it individual stocks, active investing or passive investing,
All be
everything is going to go down while the markets fall. But when the markets recover, right? When the markets recover, not all portfolios and stocks will go in tandem with the market, right? So that is additional risk which we call as non-systemic risk, which is stock picking, specific stock picking or fund manager choosing risk, which is additional risk over and above the systemic risk, which we also call as a market risk, right? Now, taking that additional non-systemic risk may not necessarily add additional returns to the overall portfolio of the investors. Therefore, let me tell you, passive investing is not only for learning license types. In fact, it is a stalwart like Warren Buffett, who has been one of the greatest active investors ever, I believe.
Yeah.
He has also recommended passive investing as one of the potent investment strategy for all kind of investors. So we believe passive investing and passive strategies is not only for learning license type, but for all from for all age groups, right from newcomers to even stalwarts, okay, who are into the capital markets. So if I can give you an analogy around it, passive investing is like drinking water, which is required by all living beings rather than a select few.
Cheers to that then.
Thank you.
So you've really broken down a lot of myths. It is not for first-time investors. It is actually even got its stamp of approval by none other than Warren Buffett. And like you're saying, the risks involved as well are much less. But if you are talking about so many pros about passive investing, why isn't everyone doing it? Why is it still that big gap, or why is it still that hesitation? And what do you think is going to lead to filling up that gap?
So let me give you some global as well as Indian data on this. In US markets, which is the largest capital market of the world, the share of passive funds AUM amongst its total AUM has risen from 15% in 2010 to almost 41% at the end of 2024. Right. Similarly, in India, if you see the share of passive funds AUM has risen from just 0.5 in 2010 to 17% currently. In fact, AUM of Indian passive funds has grown almost 14 times in last 7 years, and the current size of Indian passive funds AUM is approximately 11 lakh crores. This clearly shows that investors have started investing in passive funds, making them part of their portfolio construct, given that the challenges in the alpha generation remain common across the globe. So the trend which you have seen in US, it took couple of years for that trend to pick up there. In India, I can say that the trend has started picking up since last couple of years with more and more investors adopting. So be it US markets or be it Indian markets, the trajectory is going to be similar, let me tell you.
So where to? From 17% now, do you have any projections?
No projections specifically, but you have a number, right?
Yeah.
You have a number for the US markets.
Yeah.
There it has moved from 15% to almost 40% in last 14 to 15 years, which is almost 1.5 decade.
Got
So
it.
you have the US numbers. You can derive the numbers for India as well from that.
So let's talk about Angel One Asset Management in particular. Why did you decide to launch an ETF and an index fund based on the Nifty Total Market Index as your main offering?
See, Aman, we wanted our maiden fund offering, which we hope will also become our flagship fund. We wanted a product that aptly describes our tagline. Our tagline is investment without guesswork. Okay, that is the tagline of Angel One AMC. So if an investor wants to benefit from India growth story, he or she is perplexed with multiple choices. There are multiple quantum of choices, over 520 equity funds, almost 520 equity funds, 4,500 listed stocks, and a vast array of PMS and AIFs, right?
Yeah.
Therefore, we believe it is investors' unspoken wish that can I just have one product
Yeah.
One product that covers all market segments. While I say market segments, I'm talking about large cap, mid cap, small caps, micro caps, all styles of investing, be it value, be it growth, or be it hybrid, all sectors, all themes, eliminates fund manager and stock selection risk, and has its performance aligned to the benchmark and is also cost effective. So the answer to investors' dilemma was a Nifty Total Market Index fund and ETF that covers almost all sectors, styles, themes, via 750 stocks spread across large caps, mid caps, small caps, and micro caps, and therefore eliminates the need to do any kind of guesswork or forecast of which individual large cap, mid cap, or small cap funds or sectors or investment styles will do well in the future.
Okay.
Right? So Nifty Total Market Index provides maximum market cap exposure to the extent of almost 95%. The number keeps changing with the markets going up and down, but currently it is around 95% market exposure, which is much higher, than a lot of other popular indices like say Nifty 50 or say a Sensex. Hence, we believe that this is a logical way for any investor to participate in the India growth story. In fact, let me tell you, it isn't surprising to me that currently the single largest by MF I mean the single largest mutual fund scheme in the world is based on US Total Market Index.
Okay, so it seems like passive investing is sort of all of these great things such as different styles, different themes, different sectors, all wrapped into one, and you're getting exposure as an investor to all of this and in a cost-efficient way. So any concluding remarks for some people maybe who still have hesitations about it, or what your projections are, or what your outlook is?
So I would like to conclude this session by quoting an American economist who has won a Nobel Prize. He says that investing should be dull and boring. It should be more like watching a paint dry or grass grow. If you want excitement, take $800 and go to Las Vegas, right? So investing via ETFs and index funds may be dull and boring, but let me tell you, it will help investors create long-term wealth without getting involved in any kind of guesswork, be it stocks, choosing the right kind of stocks, or which fund managers are will outperform in the future. So no guesswork if you invest via ETFs and index funds.
And I think that is exactly what investors want. Stable, maybe boring returns, but something that, you know, is really giving you the bang for your buck.
Right.
Hemen, thank you so much. I think you've really unpacked a lot. You've given us an insight into what are the pros of passive investing, how it's applicable to every investor, how it's cost effective, and how you see a lot of tailwinds for growth. So thank you for joining in.
Thanks, Aman. Thank you.
All right. I hope that episode was super helpful and insightful to you. Hemen Bhatia really giving us clarity on why passive investing is picking up, and more importantly, how it can work for an investor like you. So if you enjoyed this episode of The Passive Edge, do remember to follow us and maybe share it with a friend who's asking, where should I invest? This might just be the answer. In our next episode, we'll be talking about the power of index investing. A deep dive into the index, how it works, how you can invest in it smartly through ETFs and index funds. I'm Avan Dabash, and until the next episode, keep it simple and let your money do the compounding.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.